Yeah, so 2022, I think it's definitely going to be an interesting one. Cycle-wise, I think this is if you're just looking at Bitcoin and crypto, this is a bear market. But I think there's a number of reasons for that, the impact of that to be diminished. The impact of the cycles and the halvings is much more dampened now, I would say. And that's driven by institutional adoption. It's driven by diminished impact of miners, the reduced supply and control of new supply that they have. It's also driven by the market being much more bigger and efficient today. So we didn't have the blow off the tops that we saw in prior cycles. The relative extremities were much more diminished on the upside, and I think they'll be more diminished as well on the downside. And that is also furthered by the macro environment I think that we're in, and the drivers for institutional, country, and company adoption, which I think kind of moisten the lower base floor of the price through time. So, we used to see sort of 85% drops in prior bear markets. I think this cycle, I'd be surprised if we get anything that deep. Of course, there's always the outlier events which could trigger something. If there's a major macro TradFi meltdown, I think that will have have an equal or larger effect on crypto. But withstanding that or withholding that for now, I think the downside is a bit more constrained than it used to be. Likewise, so is the upside. The market is much more efficient, and we talked about this in our January newsletter on caprioli.com, talking about 2022 market. And a lot of on-chain metrics, a lot of even technical metrics, the extremities are much lower. That MVRV is one example where we just do not, over time, the highs and lows that you see on a number of these metrics has dropped with time. It's kind of funneled down to a lower level, which is just a sign of the market being more efficient and people being more aware of these metrics, counter trading them or using them for liquidity. And just this information being much more prevalent. Prior cycles, a lot of this stuff was done on Excel sheets. Only a few people were looking at them, whereas now they're on. They're everywhere. They're very public, and that is great. But it also means that unless a metric or a data point has a lot of, a really high hit rate, it's kind of less. So in some cases, less reliable because there's a lot of noise in there. So. It's just I'm trying to summarize the nature of the market participants, the data, and everything that's available today, and just being $1 trillion asset class. This Bitcoin crypto, it moves very differently. It's a much bigger beast. It's slower moving. You just have to zoom out on a chart, and you can see how different the last year was. So I expect that this is kind of the bear market vibe that we're in now, but it may not get that low. I think. Personally, we're already in a sort of a value type spot. Doesn't mean that we're at the bottom, but if I put it on a scale of 0 to 10, for example, 0 being generational bottom and 10 being some kind of pico top, I think we're probably around a 3 or a 4. So, good value opportunity, but doesn't mean we can't go lower. And my reference to that is I haven't seen, in terms of the potential depths that we could go, Bitcoin tends to shock and surprise people, both the upside and the downside. And I haven't seen a flush out of a number of metrics to the downside yet. We may not get them just because the market's more efficient, just as we didn't get a number, to the same level of upside that I would have expected last cycle. But any kind of shock event could drive us down there. And what I'm talking about is kind of the 20s to 30Ks. Would be the 0 rating as I'm talking about. So the absolute sort of greatest opportunity in my mind. I'd be very excited to go max long, so to speak. Personally, that is. But that said, where we are now, a 3 or a 4, I think that's a great value opportunity. I think on a 1 or 2 or 3 year horizon, that's probably going to do very well. I think it'll probably be much higher. It's definitely on the more value side, I'd say.
I'm totally agree on that because, as you mentioned before, MVRV reached about 175, which means the average panel for all wallets on the blockchain is just 75%. So we might not hit the cyclic bottom if you see the historical pattern, but the majority of Bitcoin holders, like miners and Bitcoin holders who have Bitcoins for like over 7 years, and institutional investors who joined the last year, they didn't move any Bitcoins so far, I think. We've been tracking those wallets. Newbie who joined last year, they're holding their Bitcoins and then, so to speak, evolving to long-term holders. It's really hard to see below 20K because they are not gonna sell their Bitcoins for those newbies.
Yeah, I agree. I kind of, there's always never say never. There's always the off, event we can't foresee now that could drive it. But I with the data we have available today, I just do not see anything below 20K happening. And you're right. The supply side looks really strong. That's probably one of the better metrics today. Continued outflow of supply from exchanges and into larger wallets and that sort of thing. Yeah, it's the demand side which has been a bit lacking, obviously, and the demand side which has probably been more tied to the TradFi markets recently and just correlating to the downside, I suppose.
What's your take on the hash ribbon in this cycle? While the hash ribbon did not back the market direction and it was indicating bullish signals, the price dropped massively. Even in this case, do you think the hash ribbon indicator can still be significant? If not, how can it be supplemented?
I still think it's valuable. I think every signal since that indicator has gone live has been profitable, at least in the short term, and usually very, very profitable. So personally, I think it's one of the better buy signals out there still. That said, it was never meant, it never had a sell signal associated with it or an exit signal, right? And that was because it was even with other metrics too, I find it's much easier to get a better reading when you're in a deep, extreme undervalue opportunity to buy and hold for the long term. It's trickier to find an equivalent opportunity to sell or exit. And that's because even if you just think about simple dynamics of taking a long versus the short, the short, if you sell something at $100 and you expect it to go down, your maximum return is 100%. If you buy something at $100, it can go up 10x, 20x, unlimited, right? So Bitcoin has often, at least historically, gone up in multiples into extremes, so it can be harder to time the top side. That doesn't mean there aren't metrics which are useful for managing that risk, but at least with hash rate and hash ribbons, I never and still haven't been able to find something which is useful for timing downsides. So that's worth bearing in mind, that if you're using it as a buy signal, you have to understand that there will be periods of downside. Usually that is after a good period of positive return. There's no one metric or signal which can be used to outperform indefinitely everything. You have to use a portfolio or a confluence of signals to manage your market risk and exposure. If you look at it over a weekly or monthly or even multi-monthly horizon, all those signals have been pretty profitable. But that said, I intend to continue using them because of that. And until that hit rate stops, I will keep using it. But I do think, and this is speculation, but I do think that in 2, 3, 4 years from now, the current signals probably will either have very little return opportunity or will potentially have no value. It's a factor of, firstly, the diminished impact of miners on the network. A couple of years ago, miners were the biggest players in crypto, and then you had pretty much just retail traders, and there was only those two entities, more or less. Today, it's, miners are a small element of the pie of ETFs, funds, countries, banks, etc., all trading with much more sophisticated information. And historically, miners were just trying to manage their cash flows. They weren't trying to, necessarily trade to the optimal. Whereas now, the market is very different. It's much more efficient, and the miners are smaller players. They also have less supply impact into the future with each halving. Obviously, that the impact of a minor capitulation, I think, will diminish with time. I don't think it's going to go away because it's a nature of reflexivity as well. If a mine is capitulating, it usually means price is low, probably means other things are happening. Maybe it means there's a macro or a TradFi collapse has happened. So I still think that the hash rate signal will be useful. I just think that the impact will probably reduce with time. The other element of that is, I think, any signal which offers alpha and has a track record of that, like hash ribbons, will be, it gains more usage, it gains more eyeballs looking at it, and then ultimately with time, I think I can imagine people could counter trade that, because if you're looking to unload a massive position and then that there's 100,000 people trying to buy a hash ribbon signal, it makes sense that you might use that timing to manage your liquidity. So I don't think we're at that point now, but it could happen.
Can you briefly cover your Bitcoin production cost indicator?
Yeah, Bitcoin production cost was an indicator, and I wrote an article about it a couple of years ago. It was basically me trying to estimate, how much does it cost to produce one Bitcoin, and theorizing that would act as some kind of either price floor or at least an area of opportunity if the price of Bitcoin were to reach the price that it costs to create one Bitcoin. So, I used some data from Cambridge CBCI on mining hardware and hash rate data, and basically we know that the hash rate of Bitcoin, so we know the energy used to create a Bitcoin. We know the Bitcoin inflation rate, it's fixed by block and what will be produced. So we know the energy going in, we know the quantity of Bitcoin coming out. The only question mark is, okay, so the hash rate just represents the energy that was finally used to mine, but there's more energy that goes into Bitcoin and is lost in heat and other inefficiencies in hardware. So that, though it might sound insignificant, is a very big impact. So hardware efficiency of Bitcoin rigs has gone up, like, I don't have the number in front of me, but something like 10,000 times in the last 10 years. And there was a huge step change 3 or 4 years ago, which massively increased the efficiency. So with time, the rate of energy going in is closer to 1-to-1 of what is used to mine Bitcoin. So anyway, that gives you the energy going in, and then you can do a number of surveys or get the information on the market on what the average electrical price is globally. And effectively, you just multiply that all out, energy in, cost in, and quantity of Bitcoin produced, and then you get a price per Bitcoin. And there's obviously some assumptions in that. I had also, based on some surveys and other sort of traditional finance measures of operations costs, had to estimate, that's just the electrical side, but what is the cost of running a business in mining? There's admin costs, there's building costs, rent costs, hardware costs, depreciation, all that kind of stuff. So came up with a factor to allow for that, and that at the moment is about 40% more than price, give or take. And what you get is, when you add all that together, is the production cost. At the moment, it's around 35K, up or plus or minus a few K, depending on how some of these assumptions you make. And then the electrical cost is at the moment around 22K, I believe. And that electrical cost is basically just only considering electricity. So if the price of Bitcoin goes to electrical cost, it faces a miner with the question, do I want to keep the electricity flowing to these mining rigs to mine Bitcoin, because my electricity bill is now the same as the Bitcoin revenue I'm receiving effectively. Now, there's, in reality, if they've got a long-term view, or if they think, the price of Bitcoin will probably rise, et cetera, they may continue to operate at a loss in the short term, as many businesses do. It's just that historically, at least for Bitcoin, every time it's touched the electrical cost, which is only 2 or 3 times in history, it's been like the generational bottom opportunity. So that's in kind of the low to mid 20s at the moment, which is why, as I was saying earlier, I just don't see us going below 20K pending a bigger meltdown. And these numbers can change, right? Like, they change with the number of hash rate going into the network. So if we do get a big drop in that would change. If, if a country like the US or someone banned Bitcoin mining, of course, all these numbers will change. But given the data today, they're the price levels it's at. The other thing I did a tweet yesterday I was thinking about is just the impact of inflation now is so significant. If you just look at a chart of the M2 money supply and just draw, parallel lines to that curve, you can just see that it's just ratcheted up every 5 to 10 years. The rate of money printing has just continued to increase for like 30 years, basically. And at the moment, the annualized increase in M2 is about 13.1%. So, for the 10 years before Corona, it was about 5-6%. So that's a massive kind of leveraging factor. We're obviously seeing that now in CPI and gas prices, everything, and obviously war is not helping. So I think there's a valid case to potentially ratchet up the cost factors of electrical cost. But that's it's early days. That's a judgment call from anyone using that. And if you do that, the production cost is more around 37K, and the electrical cost kind of mid-20s or in that region. So that's why I kind of think that any Bitcoin price, given today's data at least, between 25, 35K is like a fantastic opportunity. And it just, obviously that value opportunity increases the closer you get to it.
If you want to give 2 or 3 indicator or on-chain metrics or any other indicator that you think is worth to mention to the analysts to use to follow and study the behavior of miners, what would those be like?
So I tend to keep it quite simple with mining and just look at primarily hash rate. I think that's a great measure of a number of things, of network security, of growth, of adoption. If hash rate's going up, more miners are committing to the network in the long term. If hash rate's going up, the energy value is going up, the production cost is going up, the electrical price is going up. It's just a healthy measure of adoption from the supply side. It also gives you information from a reflexivity to the demand side, because if miners foresee the future of Bitcoin as bleak or as another altcoin or as something else is better, they will obviously shift their hash power and energy potential to another network or to another business and move out of Bitcoin. So it gives you a lot of information in that simple number, and it summarizes the global market pretty precisely. If you get a really high spike, it tells you that there's something positive going on, and obviously you want reinforcement with that through time and consistency of hash rate going up, which you can use to monitor it. So there's plenty of good researchers out there. Cambridge is one. And other studies of the mining space, which will give you a lot more detailed info and granular info on this stuff as well.
What is your top metric that you're using from CryptoQuant?
There's a few, and it also changes with time based on what I think gives the most useful information to me at that time. Exchange reserves is one which I pay a lot of attention to. I think the overall macro trend of that is extremely bullish, net down, which means that there's outflow of liquid coins from exchanges, which means that people are probably on net tying it up into savings or other asset vehicles. With something like exchange reserves, I think any kind of major short-term movement is worth paying attention to. You often do see, if you zoom in on the hourly or block level on CQ, if you see like a 1% or a 2% spike in exchange reserves, you'll often see that the next 24 hours or several days after that, the price of Bitcoin might tend to decline because probably someone is unloading. That's a generalization, but it tends to be a good risk metric to look at. So I like to look at that one. Other one is obviously open interest and funding rate. There's some good variations and metrics you guys have of things like open interest with RSI that your community creates and tweets about, which are quite interesting and help identify sort of risky levels. And key one of your metrics, I think, the exchange whale ratio is also pretty good. I think that's pretty good at, like, as you identify when it goes above 0.5, it can often mean that, particularly if you're at the highs, that there's a dump coming, at least in the short term. So all these metrics are are useful on different time horizons. Something like that one, I'd be keen to hear your thoughts, but I think exchange whale ratio is probably really good if you're looking at taking a position, for hours or maybe a day or two. But beyond that, it's obviously because it spikes around a lot, it can be mostly noise. So it depends on your time horizon. In my opinion, a lot of on-chain metrics are useful or mostly useful, offer the most value at extremities. Extremities being extreme highs or lows in those readings. And usually when you get those readings, it's months before you get the opposite reading. So by the nature of that, what that means is that these data points or on-chain analytics, for me, is more useful over a multi-month horizon of if you've got relative value or undervalue and how to position yourself. But I think there's other levels to that. There's other professions to that of micro-analyzing this stuff and creating strategies which trade, again, like the whale ratio on the low time frame or tracking particular, I know a number of traders who track specific wallets of other traders or institutions and use that to drive short-term strategies. So yeah, there's opportunity out there, depending on how you slice and dice that data. It just depends on your time horizon and your philosophy. But those four metrics, whale ratio, open interest, funding and exchange reserve are probably my most interesting ones at the moment, because I feel like they have probably the most consistency of a lot of those metrics out there anyway.
I noticed that you're on CryptoQuant that makes algo trading part of it. And you also mentioned that there could be a possibility of all the metrics becoming less efficient for the crypto because all the people are seeing it, right? So then would your fund be affected too? Or do you think that new and other efficient metric would appear? Also, what would be the biggest difference between running traditional algo trading fund versus crypto algo trading?
We've definitely been affected. So in the last year, we saw a number of our more profitable strategies, just their hit rates, which were very high in the past and did well for 1-2 years, just either stopped working or reduced massively in their success rate. So we had to reshuffle and rebuild a number of things last year, and we're it's a continual process of keeping up and adapting to markets as they develop. And that's always been the case. It's just that there was a big step change with the institutional adoption last year. That said, I think there's definitely long-term opportunity there. You just have to look at a number of the funds and entities in the traditional finance space which have been successful in the long run. Obviously, it's not easy to do, but it's definitely possible. And there's always data and insights and models that are available which potentially other people aren't looking at. I think for Bitcoin and crypto, it doesn't mean that nothing works anymore or that all the old metrics don't work. It's just you just have to keep a careful eye on what you see as important. Most of the stuff you see circulating Twitter, you should be cautious of, or at least do a lot of due diligence in if you want to action it. Some of the basic raw old school metrics I think offer a lot of value still, such as NVT. So this kind of the P ratio for Bitcoin. To date, it's performed very well, even in the last year and a half, in terms of identifying risky regions and undervalued regions, such as we've been in recently. So there's definitely opportunity there. It's just a changing game, and you have to adapt to newer models, and then you have to weight more recent data more heavily. That's performed in more recent times as well.
Coininfo and number go up. Please DM us after this call's over. We'll DM us your username and user email of our site, then we'll give you 39 credits.